What is up, YouTube? This is the Working Investor. In this video, we're going to talk about my leap option strategy with a short call, basically making a poor man cover call on ticker symbol UGL, which is 2x leverage gold. We're going to talk about why I'm doing this, why I want to have some gold exposure, and how I'm using a capital efficiency of getting 4x leverage gold by using options. So first of all, UGL is the only 2x leverage gold ETF out there in the market. There is something called a 3x leverage gold ETN, which means exchange traded note, but that has risk, credit risk. The Bank of Montreal has a ticker symbol SHNY, but if the Bank of Montreal defaults, which I don't think it has, then you have equity risk. And if you don't want to take on equity risk for 3x leverage gold, you could trade UGL, which doesn't have, credit risk. So why gold, you may ask? Because if you ask many smart investors, a lot of them say that there is a use case to have some portion of gold in your portfolio. By the way, everything here is not financial advice, tax advice, legal advice, or any form of advice. This is for information and educational purposes only and entertainment purposes only. Please speak to all your advisors and see all my disclaimers. So Ray Dalio, the Ray Dalio suggests maybe a 7.5% allocation of gold in your portfolio. There's another investor, Harry Brownie, and this investor suggests 25% gold in one's portfolio. So you see a lot of smart people do see the hedge of gold. The correlation to gold to the SPY is close to zero. I saw about 0.08, about the same as treasury products. And it can serve as an inflationary hedge because of the low correlation to the overall equities, this precious metal commodity. So let's look at the details. I'm going to show you step by step how I assembled my trade. So I went to ProShares Ultra Gold Fund, UGL, like Uggle. And basically I have to tell you, there is not the best liquidity. So I don't really, feel it's good to swing in and out, and it may take a while to get filled. But if you look at the overall chart of gold, right? So of Uggle is up year to date 51.37%. While the market has been crashing, gold has been on the uprise. 51% is like a 5-year return in the S&P in some cases, in some years, not until recently, but that's a great return just in a few short months. Of course, gold did drop at some point, and that because when fear gets so crazy, people even start dumping gold. But eventually people buy gold back, it seems like. If you go to the 5-year chart, if this has been around, it's up 133%. So this year has been the biggest spike. And China, I heard, has been buying gold by the metric ton. There's some talks that they don't want to use the dollar to back up their transaction. They may want to use gold. So there's if you're concerned about those things. But of course, gold is cyclical. And also don't forget that there are special risks with leverage funds, such as volatility decay and volatility drag there, whereby if the market is choppy and it's kind of stays sideways, with a leverage ETF that gets reset daily, you may actually be down. So there is some inherent risks with using leverage funds. You could turn regular GLD into a leverage play as well. Like if you go to the 5-year chart, let's just look over here, the 5-year chart, 133%. And looking at the GLD, which is non-leveraged, the 5-year chart is 92%. So still pretty good. You see that 92 plus 92 is 184. And so you see that it didn't give you 2 times the return with the 2x leverage fund. So there is some risks, and I really want to bring that out to you. If you didn't want to use the double leverage fund, and we'll get back to the leverage play, you can literally go to GLD. Right now, if you wanted to buy 100 shares of GLD, you need $30,600, which is 100 times 306. But a leap option is you go to trade options. let's say you go as far out as you can. You can go, you could, let's say we go to January 15, 2027. So you're giving yourself a nice couple of years for gold to do its thing. And let's say you go to buy, not sell, buy call. So you're buying a leap. And you see on the left, there's the delta. So I'm looking for like at least a 0.7 delta because I want to be in the money, deep in the money. And then let's say we do I like an even number, 295, or like increment of 5 or 10, because I tend to find more, like this has at least 276 open interest and 104 volume. So I like that. So you see, you could pay 46.45, multiply that by 100. So you could pay 4,645. 4,645 is a fraction of the cost of 30 grand, So you're paying a small fraction of the cost. You're actually paying only 15% of the cost. So 1 divided by 0.15 is 6.66 leverage. You can get a 6.66 leverage. You could create your own strategy of a 6x return without using margin and without using a leverage fund. I just want to bring that up over here. And remember, gold GLD is trading at 306. So if you were to do this trade, your break even would be 295 plus 46.45. I have it already calculated on the bottom here on the right little column. Break even 341. So your gold needs to go at least above 341 in about 2 years. So if you do 341 minus 306, that's $35. $35 divided by 306, you just need gold to go up 11% in 2 years, divided by 2. You need gold to go up about 5 or 6%. If gold goes up 6% per year over 2 years, you're gonna be supposed to be in the money and you should be profitable. And if you search on Google AI, it says the average price gain of gold per year has been roughly 8 to 10%, depending on the time frame considered. So basically, historically, it's gone between 8 to 10. So that's greater than 6% per year. So if the past gives you an idea what the future would be, you'd be in very good shape. Of course, this year was extraordinary return. And of course, there could be mean reversion if it's overpriced. But on average, you have the odds on your side. Again, past performance is not indicative of future gains, but the past tends to rhyme. Now I almost want to do the trade on GLD, which I have done in the past, and I've actually made about a couple grand off the trade. So let's do the trade right now. I'll show you what I've done. So you go to trade options, and let's go to furthest out I see here is March 2026. I personally like to go typically as far out as possible because I feel like when I'm on the buying end of options, I get the best Costco bulk price deal. I don't know if Costco has great prices, but you get the best bulk price, wholesale price, if you break it down per day, how much you're paying for the premium per day, because less theta decay when you're further out. So let's go to, I did one already, so you could probably see it. I did the 130 call, which I bought. I actually bought it for $29. So I paid $2,900 up front for this call. So I like how in Robinhood, they give you a nice visual. So you could see here, I'm just going to press continue. There's not enough shares. Oh, yep, you got to press the buy button, not the sell button. So sell call. Whoopsie, big mistake. Did that ever happen to you guys? So let's do one. We'll do the $29 price. And you can see the bid-ask spread is horrible. Horrible bid-ask spread. There's not a lot of liquidity. That's kind of why I like GLD. The more I keep talking in this video, the more I want to do it in GLD. Because liquidity is great, and you could do poor man cover call like several times a week. They have, I think, 3 expirations per week. There's so much liquidity. Look at this, open interest 1, volume 2. All right, so this is what I've done. So if you go to review, where is that? So you could see that if gold, it's a very bullish strategy. Obviously, if gold, the most I could lose is the money I put up, which is $2,900. But my gain is basically unlimited. Whatever gold does, this will give me 2x leverage, amplified returns in both directions. Don't forget, you don't have to have gold go beyond the break-even point necessarily. If gold moves even a little bit initially, right, even though it says, let's say, estimated profit loss $961, that means that's at expiration. You see a UGL price at expiration. But if it moves up today or tomorrow by $5-10, you can get out of this for a profit. You don't have to wait. If you wait all the way to expiration, there's no more extrinsic value. There's only intrinsic value. So yes, you would be at a loss. But if it moves up, you're going to be able to get out at a profit as long as liquidity is there and doesn't kill you. So I did that part of the deal. And the next part I did was I went to the May 16, and remember, if you look at my break even, very simple. My strike price was $130. I paid $29. So $29 plus $130 is $159. So anything above $159 is my break even. So I sold a short call to make some profit along the way. I did a monthly, and I didn't do it on 160, I did it on 170. So I'm giving myself additional breathing room of $10, which is if you multiply that by 100 per contract, 100 shares per contract, that's $1,100 breathing room, because 159 to 170 is $11 times 100 is $1,100. So if gold blasts above 170 by May 16, I will collect the premium that I've received, and I would have additional $1,100 just for, this trade. So you may ask, how much premium did I collect from this 170 call? So I collected $80 of premium for this call. Of course, gold moved up in price. So if I wanted to close it out, I would take a loss. Or I don't have to close it out and let gold go and blast right through it and get my long call taken away. Not bad to make $1,180 in about 29 days if gold goes above this. If gold goes down, then I'd have to sit there and wait until it kind of goes back up, and I could try to keep selling covered calls above my cost basis if possible. So I'm kind of betting on gold prices might be going up, because you could see here in the first quarter of 2025, China's gold purchases reached 12.8 tons, resulting in a record high inflow, So basically there's tons of gold that's being gobbled up. Of course, it also has its own cyclicality. It has its own cycles, and I'm aware of that. And that's why this position, this combined with my other gold in my portfolio represents less than 5% of my gold exposure, just to, and that's, I've hit my allocation that I want. So I'm just trying to make some income, make my own income fund. Can you imagine there's an income fund that says 4x leverage with capital appreciation and short calls of gold? And if you look at my return on this, and I don't like to always calculate it unless it's consistent, because you can always make a good return one time, but if it's consistent, that's what matters. So if I let it go to expiration, it's $80 divided by, I put up $2,900 is what I put up. So, 80 divided by 2,900 times 100 is 2.75%, right? But that's 2.75% in 29 days. So if you take 365 days of the year divided by 29 days is 12. So this times 12.58. 12.58, multiply it by 2.75, that's a 34% annualized return, which is a modest return. But I'm getting some money, a 34% annualized return for the next 30 days. I don't know what's going to happen the further 30 days. I may be messed up. But for the next 30 days, as long as I keep this trade on, I may take it off. It's a 34.7% annualized return. And I'm getting gold exposure, and but it does come with its own risk. And as you guys saw, you don't have to do a leverage fund. You could do it on GLD or something. Again, not financial advice. You have to think about your own risk parameters. Anyways, this is the Working Investor over and out. I hope you guys have a wonderful trading week.